All right, it's time for our call of the day. BTIG's Jonathan Krinsky with a new note today saying energy could resume its leadership role. The sector was up 5.5% last week. It is the only negative sector so far today, down about 1%. All right, Joe, I'm coming to you first because this is how you are positioned.
Correct.
Right? You're double, I think, what the S&P
10%.
is, right? Okay, it's EOG, it's Pioneer, it's Valero, it's Chevron, Devon, Energy Transfer, Diamondback, Kinder, and Exxon. You think he's right?
I will certainly hopes that he's right. Do I think he's right? I think the early signals of it are, yes, present in the market. Understand the commodities trade overall, collectively, you've got CTAs that are very, very short. They're very short in the futures market itself. Last week, you had a 5% recovery in the energy equity names. I think that's the initial stages of something that could be building specifically towards oil. I don't think it's universal in the entire commodity space. We'll talk a little bit later in the show about the agriculture trade. I think it's specific to oil. This is the moment. You need to see it build momentum to the upside for Jonathan to be right. It has to happen here and now.
Okay. What if he's wrong? What do you do with your positioning there?
The end of April, that'll be addressed. That's the next quarterly rebalance and reconstitution.
What about your personal holdings?
My personal holdings will be addressed at the same time. Most of my personal holdings right now are in Joe T. But is there a likelihood that he could be wrong? Yeah, I've said that. I've said that commodities have lost momentum for sure, and there's an argument to be made that the peak commodity story is in play. And if you look at the yield curve inversion, which is the deepest and most significant that it's been since the early 1980s, it's reflected in the pricing of commodities.
So, Jenny, it's Devon, Energy Transfer, Kinder. You got a lot of crossover with Joe, Pioneer as well, and Shell, which is yours. Joe doesn't have that, but you do.
Right,
but what about this space? What about this call?
Well, I think if you say energy is going to maintain or get back its leadership role, you need to be expecting not a lot from anything else. Because we need to remember that energy was up over 50% in 2021 and 2022. So what do I expect energy overall to be up this year? I don't know, 10, 12%. So if that's leadership, what does it say about everything else? And when you say to Joe, what happens if you're wrong? For me, most of those names are in our U.S. dividend portfolio. Shell and Total are in our international dividend portfolio. But if you're kind of wrong, you sit there and you just scrape the dividends and hope that the share prices plateau, which I think they should. Because with oil above $60 a barrel, these companies continue to make cash. And again, this gets all back to valuations. Their share prices are not priced to any sky high. A lot of them are under 10 times earnings. And I sold Chevron. That was more because of the dividend yield. But some of the majors, some of the popular ones like Chevron and Exxon, some of those multiples are getting a little stretched. So I'm playing right now really in the dividendy space. Kinder Morgan, Devon, Pioneer, ONEOK, Williams, and what do I want from them? If I get a 12% return from them this year, I will consider myself very happy.
Weiss, you got Devon and you added to Chevron last week, right?
Well, I added Chevron last week.
You added Chevron last week?
Yeah, because I've been underwater. Stock traded below 170, and it's about there right now, so I added to it. Look, I don't really let technical analysis inform what I do because I'm strictly bottoms up. However, if somebody listened to Krinsky, and I hope he's right this time. But to me, energy remains long-term uninvestable. It's tradable. But you went through a 10-year period up until last week where you basically were losing money every year for 10 years, up until last year, rather, not last week. So
what time frame do you consider to be, quote-unquote, investable versus not?
Yeah, what's a trade?
6 months to a year is a trade versus others that you can own, core stocks for a long time.
You could have owned energy all of last year, right?
Yeah, exactly. So that's an anomaly. It's not me saying it, it's fact, right? The stocks have major down cycles, and we saw one for 10 years where it underperformed massively.
No, I understand, but what I'm saying is last year it had a pretty damn good year, didn't it?
Yeah, look, it did. It did. Had a great year, and I missed it. Look, here's what I'd say. The dialogue, no offense, Jenny, that, hey, oil can go to 60 and still make money. Well, it doesn't mean the stocks, you're not going to lose your shirt if that happens.
You shouldn't lose your shirt. They're hugely profitable.
Why is that any different than saying, hey, Microsoft's earnings can be cut in half, but you're still going to be making money?
Because at 60, they're not cut in half. At 60, they're still making tons of money. At 60...
You missed my point. You missed my point. They are the way the fundamentals move are informed by the value of the commodity. And if the commodity is lower, it's because demand is down.
But you know what? That's actually not true. That's not true.
It is true.
No, it's actually not. Everybody wants to pretend it is
It's not
because
supply-
Let her make a
last
point.
year when Chevron was at when oil was at like 140, Chevron was way lower than it is now. Right? You could have bought Chevron at like what 120, 130 when the commodity price was at 140. Now the commodity price is at 75, Chevron's at 170. So they should be linked, and people pretend they're linked, but they're not actually linked. And you know what?
That's just not true.
No, there was a hate
It is
fest.
true.
Everybody knows, yourself included, that there was a hate fest on energy. The students were storming the Yale campus saying like, oh, you can't put energy in our portfolios, in our endowment. And there was so much money, ESG driven, that came out of energy that it just straight up depressed the share price, and it was totally disconnected from the commodity price or from the idea that these companies were continuing to pump out cash.
Yeah.
So you could have bought Chevron at like $70 3 years ago. You would have made a nice return. I would argue that 3 years is a decent investment time frame, not just a trade.
Here's the mistake in your logic. You're extrapolating a one-time event that's never occurred since the button tree for energy stocks, which is the ESG phenomena. Okay, so you can't equate that to how, or use that as an analysis to how energy is de-linked from the commodity. That was one time event, maybe it's going to continue, but energy stocks trade upon where the commodity is, which is why Chevron's down. Guess what? You know why it's down? Because nat gas is down, and energy prices are down.
Let's let Joe deal with that question. The linkage between the commodity price and the performance of the equities.
So I think,
and then we're taking a break.
I think you have to.
I was having so much fun.
Okay, so Jenny mentioned 140. The high last year for the price of oil was 130.50.
All right.
You did not spend enough time above 120 to really impact the earnings ability of energy companies. I think there was only 7 days, the entire year, where the spot price of oil was above 120. So you had a little bit of a parabolic move, and then it pulled back. I think you have to look at it, to your point, what's the average pricing over a yearly basis, which is more in the sweet spot of 80 to 85. I think that's the right range to think about it. And as long as you have that fundamental support for the underlying commodity, I think energy equities will do well. One last real quick point. You mentioned something that's interesting, which is energy gives you 10%, means everything else doesn't do well. I just want everyone to think about this scenario. China reopening. We keep talking about it on the network. China reopening means a higher price for oil, which means a higher, bumpier inflation path, which means difficulty for the remainder of the S&P sector.
Why are you talking then about potentially peak commodities, and then on the other hand, you're talking about China reopening, which...
But the peak commodity story has been in play since June of last year. That's when all the commodities kind of peaked out. Now, to get the re-acceleration, to get the positive momentum going again for commodities, the potential positive catalyst is the China reopening.